The best stock to buy right now in February in terms of risk versus reward is Uber. I'm going to share with you all the reasons why I like Uber stock as an investment, including its valuation. And I'm also going to share with you the big risk, the reason why Uber stock is trading at this lower valuation, offering this opportunity to investors. So let's get into it.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so out of the 150 or so companies that I'm following, I have Uber rated as my top stock to buy, and I updated that recommendation today, February 2nd. I've had Uber stock rated as my top stock to buy for all of 2025. I started 2025 by ranking Uber as my top stock out of my whole coverage of stocks that I follow, right? And one of the reasons I'm attracted to Uber stock as an investment is the customer value proposition. If you're following my channel, you've probably heard of my 6-step framework for analyzing stocks. And one of the steps in my 6-step framework is the customer value proposition. How much do customers like your product? And for Uber, it's a lot. The company's revenue has surged in recent years. The rate of growth has persisted at above 20% for several consecutive quarters. And that's even after the company's revenue surged during the pandemic because of the food delivery side of the business. That drove significant revenue growth for Uber during the time when people were stuck at home and restaurants were closed to in-person dining. Still, even after the economic reopening, people continued to order food for delivery, which surprised me. It caught me off guard. And I looked into Uber more intensively after that development. And I started to realize that, you know what, this food delivery option is a really good value for customers. People pay, a fee between, whatever it might be, let's say $5 or $10 or $20, depending on the size of the total order. But it saves people so much time and it adds so much convenience. You don't have to get into your car to go and pick up something to eat. It can be delivered straight to your doorstep. You might be tired after a long day of work and you don't mind paying $5 or $10 to have a meal delivered to your doorstep. And so that side of the business has continued thriving. And then on the other side, the rideshare part of the business has been popular and continues to remain popular, even though Uber has raised prices it charges customers. That increase in prices that Uber charges customers has not increased by as much as the total cost of car ownership has increased. If you look at the average price of a car today versus the average price of the car in 2019, it's significantly higher. And then if you add to that, the cost of fuel is significantly higher, the cost of insurance is significantly higher, the cost of parking is significantly higher, and I could go on and on. So the total cost of car ownership has soared. And so Uber's been able to raise prices on the rideshare side of the business, but nowhere near that other side. And so for many people, that still offers a great customer value. I often say that if I didn't have a family and I was single, I would probably use Uber for my transportation needs. I wouldn't own a vehicle. Too much hassle and doesn't and it costs more sometimes than the Uber does. So I would own an Uber. I would do Uber instead of owning a car if I didn't have a family. All right. So as is usual, when I'm evaluating stocks using my 6-step framework, the customer value proposition is one step in that 6-step framework. But along with the customer value proposition, I look at unit economics. And I say in my book a lot, it's easy to provide a great customer value if you're willing to lose large sums of money on the bottom line. I can offer you a great product for a very, very low price, a price that's so low that I'm bleeding money and my sustainability is under question because I can't continue losing money and stay in business. Eventually, I run out of money. So along with the customer value proposition is unit economics. That's really what business is all about. Can you deliver a great customer value efficiently, effectively, where you're not running up costs to deliver that customer value? And for Uber, the answer is absolutely yes. And it's getting better and better as time goes on. You can see the cash flow from operations to sales up to 14.8%. That's up from around negative 30% in 2020. So those incremental price increases and changes in costs, incentives, promotions decreasing, that's all helped Uber generate this huge improvement in cash flow from operations to sales. Similarly, if you look at the operating margin, which includes non-cash expenses like stock-based compensation, that too has been improving meaningfully over the last 5 years, up to 6.4% from negative 75% in 2020. So let's look at valuation then. Given these excellent prospects, revenue growth above 20%, cash flow from operations improving and in double digits, operating margin improving and positive at 6% and getting better and better. Given these excellent prospects, a stock typically would trade at a much higher valuation than Uber trades for. Uber selling at a forward price to earnings of 16.35, the cheapest it's been all year long. But that's just one way I look at valuation. I've also done a discounted cash flow model for Uber, and the intrinsic value per share came to $112. The current market price is $66. I also ran 6 different scenarios with Uber stock, and nearly every scenario that I ran had Uber stock at either being fairly valued or significantly undervalued. And you can see the different scenarios. I modeled various growth rates and I modeled various betas in evaluating Uber, and nearly all of them, except if I increase the beta all the way to 2 from its current 1.34, would the market price be close to the intrinsic value calculation. So then why is Uber stock selling at such a cheap valuation? Why is this opportunity available? And the most obvious answer is driverless car technology and how absolutely effective Tesla has been at convincing the public that it will achieve driverless car technology and that its driverless cars will generate trillions of dollars in revenue and absolutely obliterate any other company that's operating in the transportation industry. That's what the market is pricing in already. The market is coming to the conclusion and just believing everything that Tesla says without actually looking at the facts on the ground. The fact that Tesla, they did announce that they will start testing their driverless cars on roads in Austin, Texas. But they also said that they're going to be starting very, very slowly, that they're just going to dip their toe in the water and really be cautious in their development of this technology. It's not going to happen anytime soon. Furthermore, I think the market is overestimating the market share that Tesla's driverless cars technology will command once it is actually operational, which I don't think is going to happen for several years. And so I think driverless car technology for Uber is not a certain negative. I think it is a risk, to be sure, a big risk, but I think that the risks are two-sided in that it could be hugely negative for Uber, the driverless car technology, if it's excluded from the market and Tesla takes the whole market share. That would be really bad for Uber. But on the flip side, Uber could also benefit from driverless car technology because one of the biggest dollars that gets allocated in the business, I don't want to call it a cost because they don't count it as revenue when a customer pays for a certain amount for a ride. Some of that money goes to the driver and then the rest of it goes to Uber. That's what it counts as revenue. But if Uber employs driverless car technology itself, it doesn't have to give money to drivers. And so that could lift the company's revenue and lift the company's profitability as well. So that could also happen because it's not only Tesla that's developing this driverless car technology. We have driverless cars being developed there's driverless cars on the road right now in Los Angeles, in San Francisco, in Phoenix, in Las Vegas, and in multiple regions outside of the United States. So Uber could theoretically license this technology from Tesla or from others that are developing it and command a market share of its own in the long run. But what the market is pricing in right now is that for sure it's going to be a negative. And so that's why you can get Uber stock at this depressed valuation, because the market doesn't see the upside at all and just sees the downside of driverless car technology. They're only looking at that, which is there. I agree. I totally agree that driverless car technology could disrupt Uber's business. A there's a non-zero probability that will happen. But there's also a non-zero probability that may be equal to the negative side, or not much different than the negative side on the positive side of the outcome of the development of this technology. So for all those reasons, I think Uber is the best stock to buy. But so far, it's outperformed the index in 2025. Uber stock is up 10.83%. S&P 500 is up 2.69%. So far, my recommendation of Uber as a top stock to buy, if you chose Uber instead of investing in the index, you would be up more than 4 times that of what you would be up so far for the index. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.